And Matt, we had talked about a lot of these big banks a couple of weeks ago, and we're looking at some of the opportunities and the challenges in the quarter they were reporting. And you've gone through these releases. You've seen some of the winners. You've seen some of the losers. Tell our listeners what you found.
Well, for the most part, there weren't too many big surprises. Banks, as a rule, are a generally predictable industry, especially commercial banks. Having said that, there were a couple that stood out. Bank of America was, I think, the best out of the big four banks. They just keep improving and keep getting better and better and are really doing a good job of putting their pre-financial crisis self well in the rearview mirror. If I had told you in, say, 2010, 2011, that Bank of America was going to be probably the best looking out of the big four banks, you would have told me I was crazy.
I know I would have. And I mean, I think just a year ago, it seemed like Brian Moynihan and Bank of America, they were stepping in something new on a daily basis. And now it seems like they've passed that torch on to Wells Fargo now, huh?
Right. I mean, a few years ago, if I had told you that anyone but Wells Fargo is the best run bank out of the big four, you would have called me crazy. So times have certainly changed in that regard. But the biggest surprise in my mind to earnings were the two big investment banks, which are generally less easy to predict. So if there is a surprise, that's a lot of times that's where you're going to find it. And Goldman Sachs had a blowout quarter. Goldman had been one of the worst performing bank stocks because of the drama related to the Malaysia bond fund gone bad. And that's still definitely an overhang on the stock, which is why it's trading for significantly less than book value. But the bank, its earnings were just excellent. Lending and investing revenue, which includes the Marcus division, was up by 56% year over year.
Wow.
Which is huge. And Marcus is still a very small component of the business. They just announced recently at the Money 2020 conference I was at that they're expanding into wealth management in Main Street. They've already expanded into personal loans and savings products for Main Street. So now this will bring, even more people into their ecosystem who historically Goldman's been a wealth manager for the 0.01%. So this is really opening new doors for them. And it's been successful so far, plain and simple. They made their first personal loan, just for example, in October 2016, I believe. And 2 years later, they hit $4 billion in personal loans, which is a drop in the bucket in terms of a big bank, but is quicker than, a lending club even got to that level. So it's impressive growth so far and tons more room to grow. CEO David Solomon at a recent presentation said that possible avenues include mortgages, auto loans, insurance products, checking accounts that offered online that paid nice interest rates. So there's a ton of room to expand this. And I've said it before, but I really don't think the market appreciates what a big force in commercial banking Goldman Sachs could become. It's got a phenomenal brand name, and it doesn't have any of that legacy infrastructure that kind of weighs on profits that any of the other big banks have. It doesn't have branches or anything like that. So it has this great opportunity to grow, and it's really been reflected in their earnings. On the other side of the aisle, Morgan Stanley, their fourth quarter was a big disappointment, and it was a standout one because bank earnings generally were good. Everyone pretty much, beat earnings estimates, beat revenue estimates. Morgan Stanley did not. They missed on both the top and bottom line. Trading revenue was particularly weak. Morgan Stanley's fixed income trading was down 30%. I think Goldman's and a few of the others were down 18%. So while trading revenue was pretty weak across the board, it was, weaker than peers, which is always a bad sign.
Right.
If a certain metric's generally terrible and equally terrible, it's not necessarily a bad sign for a company. But when you're underperforming your peers is really when you want to watch out. And that's what happened with Morgan Stanley. Wealth management business missed expectations as well. And it just, all in all, was not a great quarter. When you miss on the top and bottom lines, there's usually a reason for it, and there was. And it's their trading, which is, like I said, that's the most unpredictable part of banking, in my opinion, is trading revenue. So don't read too much into one quarter's trading revenue, but all in all, Morgan Stanley was the disappointment and Goldman Sachs was the winner. So You saw over the past couple of weeks since earnings, you've seen a lot of price divergence between the two.
Sure. Yeah, real quick, going back to Goldman Sachs for a second, because it just made me think of something I'd like to get your opinion on. Do you feel like Goldman Sachs, given the move to open up their lending to a bigger audience, pursuing Main Street, given Goldman Sachs' reputation, the brand, the sort of the aspirational maybe nature of that brand from just your everyday Main Streeter, do you think there's a parallel with what they're doing with what American Express had to do a little while back in opening their product suite up to more customers, taking that brand that they've done so well over so long, nurturing it was a bit of an aspirational brand, opening that up to more clients with more products. Do you feel like Goldman Sachs benefits from that kind of boost at all?
Sure, and that's actually a great comparison.
Why, thank you.
If for those who aren't familiar, American Express was a credit card for rich people up until a decade ago or
exactly. So. I feel like most people on Main Street probably feel like, oh, forget about Goldman Sachs. That's just for rich people, but apparently not so anymore, right?
Right. And now anybody with $20 can walk into a Walmart and get a prepaid Amex card.
Yep.
So, I mean, that's the extreme end of their product line, but they've kind of become, a credit card company for Main Street. They still have their high-end products. And in my opinion, they're the best in the business at high-end credit cards. I mean, the Amex Platinum is, in my opinion, the best credit card product on the market. It's in my wallet right now. But they've done a great job of opening their business up, and it's leveraging their brand name. And Goldman Sachs actually has, in my mind, a unique advantage over peers. Not just the brand name. I mean, Bank of America, Wells Fargo, these are all good brand names too. But they all have this big legacy branch infrastructure overhanging their heads. Pretty much all of them are reducing their branch count over the past few years and continue to do so because it's really eating into their costs and eating into their ability to be competitive. If you see Goldman Sachs right now, their Marcus savings account pays 2.25%. Bank of America and Wells Fargo pay about 0.1%.
Wow.
So, and the reason that they can afford to do that is because they're not paying all these costs associated with branches, not just the physical buildings, but, paper costs, employment costs. There's a ton of costs involved in opening a branch, and Goldman doesn't have to worry about any of that. And that, I think, is going to be even more of a competitive advantage than its brand name.
Well, earnings season is just getting underway. I'm sure we have more banks coming, but it's definitely been an interesting few weeks thus far.